Hello, dear students. Now, let us start the discussion on commercial bank, which is one of the most important financial organization in any economy, any system in the world. Banking system or banking sector has grown its relevance. It has its own significance for the financial sector. As a whole, it provides all kinds of amenity, either from transaction perspective or from investment perspective. Keeping these things in mind, it is very important for us to understand how the commercial banks basically work in the system. What are the major services they provide? And why the commercial banks are so special among various financial intermediaries which work in any financial system in the country or all over the world for that matter. Today, we will be discussing about the structure of the commercial banks in India, what are the kinds of services they provide, banking industry in India, and how do these banks manage the non-performing assets. Now, let us understand what is a commercial bank and what is commercial banking. Commercial bank is an institution which is there for some kind of commerce, that is, it is also a business entity. Commercial banking focuses on the products and services that are specially designed for the businesses such as deposit accounts, lines of credit, merchant services, payment processes, commercial loans, your global trade services, treasury services, and various business oriented offerings. Commercial banks serve much larger customers than the standard retail bank, which is designed for individual account holders and some small businesses. These large banks are designed to handle the needs that businesses have for large loans, lines of credit, and deposit accounts. Often, retail banks are simple branches of these larger institutions. Commercial banks can help small businesses through a corporate banking arm as well as the enterprises through an investment banking firm, right? So they might also work with individual consumers serving like your retail banks. Since these banks are typically stock corporations, their aim is to provide a profit for their shareholders. The way they typically do this is through what is known as financial intermediation, whereby the servers who are willing to hold their deposits with the bank are matched with the borrowers who need loans. In order to facilitate the movement of money between the savers, borrowers, commercial banks, these banks needs and receive customers' deposits. They place them in different accounts and they extend loans with the interest on these deposits to businesses and individuals and pay interest to the ones who have deposited the money. Although the interest paid to borrowers represent a liability for the commercial bank, these banks typically loan funds at higher interest rates than the rates they pay to the borrowers, which allows them to turn into a profit. Now let us discuss the banking industry, how it has been in India. So if you see in India, it first originated in 18th century when the first banks were initially established. The Bank of Hindustan is one of the entities which gave birth to banking sector in India. And its foundation is in the year 1770. It later, liquidated in 1829 or somewhere around 1830. In 1786, General Bank of India was also born, but it failed and it actually went bankrupt in 1791, just 5 years after its launch. The State Bank of India, it is the largest and the oldest bank which is still in existence today. Originally, if you look at, it started as Bank of Calcutta in the mid of 1806. So it was then renamed as Bank of Bengal in 1809, along with two other banking institutions, the Bank of Bombay, the Bank of Madras. They were three presidency government funded banks in India. They merged as in 1921 by giving birth to Imperial Bank of India, which became as State Bank of India in 1955. So now let's start coming back to modern times and take a very closer look at the banking system in India and check out the Indian banking sector's, what is the broad overview. According to the latest report developed by Reserve Bank of India, the Indian banking sector is well capitalized and regulated. And this report also states that India's bank performance is and the financial conditions are way superior to any other country worldwide. 12 public sector banks, 22 private sector banks, and 46 foreign banks. So the Indian banking system consists of additional 56 regional rural banks, 1485 these are the urban cooperative banks, 96,000 rural cooperative banks, and other cooperative credit institutions. And there are more than 2 lakhs of ATMs in India. Now, this data has been updated as on September 2020. So, there are around 4 lakh ATMs in India. So, as you can see that, the trends show that the numbers of cash machine in India will almost double in the time span of, 1 year. So if you look at the growth in terms of Indian banking sector, so any relevant Indian banking sector analysis will reveal one thing. The banking sector is on a very positive trend and it will continue to grow in the world that is rapidly moving from cash to credit. So a cashless world could be very well obtained in the next 2 decades of amongst all the countries if all countries continue within the same banking and financial trends. So COVID-19 pandemic has it has also accelerated the efforts and made into putting a stronger focus on credit card payments as opposed to cash. So during COVID, if you realize, um, there is a sudden shift in the behaviors of the investors. Now, investors keenly look at, even if you look at the senior generation people who are probably in the age group of 60 and above, they have also started participating in the banking, online banking services. So, by the end of financial year 2023, it is estimated to reach a total of 1 trillion, in terms of amounts of digital lending. So, this is largely due to this is 5 times increase in digital disbursement. So, private sector has been on the rise ever since its beginning. So, starting off as a way to fund naval trading and the discovery of new trading routes, bankers from the Indian private sector have been pulling the strings. So, the global economy, for more than 500 years. Now, let us understand what is the role of commercial bank. Then another question is the banks are special, among the intermediaries which work in the system. Why? Why are they special? There are certain characteristics where the banks have the same characteristics, right? Other kind of financial organizations may not have, even if they are operating in the same system. Then what are those? The banks are specialized or banks are special to create and channelize the credit for the productive investments because bank is a payment gateway, right? Or bank has a direct connection with RBI. So whatever credit basically they provide, they can create credit and they provide only for the productive investment. The reason is monitoring system of the banks. It is quite robust. The reason if somebody wants to take a loan in Mumbai, but he is based in say Chandigarh, right? But the bank cannot, but the bank can be bought the property in Mumbai. The loan is taken in Chandigarh. Now this is possible because the monitoring system of a particular bank is extremely robust because they have branches in Mumbai, they have branches in Chandigarh and other states of the country. So the reason is that from the logistic point of view as well as from the expertise point of view, in those particular cases, the transaction cost of commercial banks will be less. So if the transaction cost is less, obviously the operations will be better. and because of that, they can channelize the credit in a better way for the productive investments. They may not be possible. They may not be possible by other financial entities. Now, which are these are the financial entities which are already there in the financial system, and this is also the act of economic support system, because for any kind of any kind of such thing, we always require banks. So if you're investing in stock market, the role of bank is there. If you're investing in forex market, the role of bank is there. Even if you have an insurance policy, there is a bank's role. So for everything, bank is linked. So that is basically a support system for the economy. So in that context, we can call the Indian banking sector is based on the is based on the economy, and there are two types of economy that you might have known. One is your market-based economy, and another is your bank-based economy. So in the Indian economy, bank-based economy, and another thing is that market-based economy. So US is a market-based economy. So there are many agents who are actually the specialized agents who participate in different systems. But in Indian context, mostly we are concentrating on the banks for all types of financial transactions which are taking place in Indian financial system. So if you have read from the economics point of view, you see economies of scale which can be possible by the commercial banks, because availability of banks are more than the other financial entities. The banks operate in a very remote rural areas. Bank also operate in metropolitan cities. Now, because of economies of scale, I already have discussed, you can reduce the cost. The monitoring system will be very robust. So because of that, whatever transaction cost we incur, if you go dealing with the other financial entities, that will become more than the transaction cost what are incurred by the commercial banks. So because of that, the services we will be better, as well as the cost from the customer side or from the investor side will also be less. Economies of scale which can be possible with respect to commercial banks. The same economies of scale, it may not be available with other financial entities or organizations which exist in financial system. So that is also another special kind of characteristic that commercial banks have. So then we have, economies of scope, right? You already know what is economies of scope. So economies of scope, in the sense we have varieties of products in the same line, which are basically provided by the companies. So you can take an example from a company's perspective. So if you can take the example of, say, Nestle, who has n number of products, basically comes to the market and they provide all the products that are produced in the same line. So they can produce oil, they can produce soap, they produce shampoo, right? Any kind of thing which are required in FMCG sector. But all the productions are made in the same line. So whenever the productions are in the same line, what happens? The fixed cost is always more or less same for all types of production, right? So only change is the variable cost. So that is why the average total cost of the company will be less. Obviously, that will have impact on the price of the product. So like at that time, the bank can provide different kind of financial services. So it takes the deposits, it provides loan, it also gives other kind of investment opportunities within the deposit, the variety of deposits within the loans. So they have got varieties of loans. So that makes that particular scope product. So the economies of scope or bank for the commercial bank is very, very, very large. So in that context, what happens? The bank is able to reduce their cost as well as provide better services to the customer on the basis of their requirement. This is what basically is economies of scope concept, which works better with commercial banks. Obviously, there are the major participations of for the transmission of monetary policy, right, mechanism, because already we have discussed that intermediate channel for the bank is, whenever we talk about monetary policy, we have already explained that there is an instrument, there is an intermediate target, and that is basically a final output or final objective or a final goal. So intermediate target is money supply and the bank credit. So because the bank credit is one of the intermediate targets. Though they have an active role, they play or very important role they play in the monetary policy transmission mechanism of a particular country. So they are also able to maximize the social welfare because they participate in all kinds of public welfare schemes, whether it is microcredit or it may be providing a part of financial institution. It can be part of any other Jan Dhan Yojana, right? Or other things which are happening in the Indian market. So all kinds of social welfare schemes which are always linked to the commercial banks, as well as they provide social justice because of those, they provide equal services to all types of customers which are existing in the financial system, and as well as in the economic system as a whole. That also carries more trust in the public, and because of that, then people are more concerned about commercial banks, or they have more faith on commercial banks whenever they do a financial transaction, instead of the faith on other kind of financial entities who provide financial services in the economy. Now, this is why we say banks are so special among all kind of financial intermediaries which are working in a particular system. Now, let us understand the structure of commercial bank. If you see, in the Indian context, the banks are regulated by RBI. RBI is the apex body, which is a central bank, and we have two types of banks, which is scheduled and non-scheduled banks. Scheduled banks means they are basically established under the Act of RBI Act. Now there are certain rules and regulations they have to follow to become that particular bank. Scheduled, and there are some non-scheduled banks, mostly cooperative banks, right? We have commercial banks, but the basic importance of Indian banking sector is always concentrated on commercial banks because they actively participate in all kinds of payment mechanism which is happening in the Indian context. So again, Indian commercial banks are divided into two parts: Indian banks and foreign banks. There are some foreign banks which are also operating in the Indian market, so we call them the foreign banks, right? Then within Indian banks, we have public banks as well as private banks. Sorry. So you will then private sector banks. So you will a little bit, if you go a little bit deeper for the classification, there are old private sector banks and some new private sector banks over the years, like when RBI is giving license to many private sector banks to start their banking operations or banking business in the Indian financial system. So we have public sector banks, you have old private sector banks, and you have new private sector banks. And if again you go by public, we classified as State Bank of India. Now this State Bank of India merged that one State Bank of India is existing and other nationalized banks like Syndicate, Punjab National Bank, Canara, right? So these are all public sector banks which are nationalized banks, and we have the other some regional rural banks, right? So this is the way overall the banking structure of Indian context or Indian market looks like. So this is the overall structure of Indian banks. But after looking at this, basically for understanding, we have to know that what are the different types of banks, right, which are existing in the Indian market. Now let us understand the different services offered by commercial banks. We can see that what kind of services are given by commercial banks. They provide many services which are very difficult to identify in terms of listing all the services. But there are some major services that can be highlighted. We can also, if there is not any other services left out in this particular list, but if you see what are those services which are provided by commercial banks? First of all, commercial banks take the deposits from the customers, because if any customer is not interested in stock market, still if they have some surplus, they will deposit it in the bank because that is the easiest and the safest way of investing the money. So at least some return can be realized from the most safest place, that is your bank. Your money will be safe, because they feel that the bank is the safest place where money can be kept. So because of that, they provide very good services in terms of accepting the deposits, and the deposits also can be very small deposits. It can be extremely big deposits, and because bank play a vital role in economic system for providing the money, as well as it is the only payment gateway to the system which exists, the money can be utilized in the system in a better way. By that, it is also affect the total investment in the economy, and finally the output also gets affected by that. So the acceptance of deposit is a major services which is given by the commercial bank. There are many types of deposits: savings deposit, fixed deposits, which are available, and depending upon the customer's requirement, the customer can go for any kind of deposits, whatever they need, right? Lending money or advancing of the loans, etc. So this is a major thing where the bank also generates profits or income. But this is one of the most important services what the bank gives, because already we have discussed that banks create credit for any kind of loan which is a commercial loan, whether it is a housing loan, whether it is a vehicle loan, personal loan, education loan, any kind of loan. So all kinds of loans are given by banks. The portfolio of loans, the lending activities of the commercial bank is quite big, large. So in that context, they also cater the services in a very big way, because depending upon the customer's requirement, they provide loan. Some customers take short-term loan, some customers take long-term loan, and all kinds of demands are created by commercial banks. So that it is one of the most important services what they provide, which is also provided by some other entities. But the commercial banks basically is pioneer in that, because the varieties of services in terms of lending activities what they give, that may not be available with any other financial entity which is operating in the financial system. Investment of funds, whatever remaining funds are there, banks basically invest these funds in different instruments. And one thing is that the bank are bound to invest certain money in the SLR. We have discussed in the previous slides, right, that the government, the banks have to deposit some certain money in SLR instruments, which are like your government securities, and rest of the money can be invested in capital market also if they intend to, or any other instrument whenever they want. So banks also provide investment services or any kind of other services what the customers need. They basically can invest in a particular fund which are provided by the banks. So now we are going to discuss it more on all the kinds of instruments which are issued by the banks in future sessions. Okay. So, but banks also provide investment services to the customers. Remittances of the funds basically just it deals with the forex business on kind of, or any kind of remittances that basically comes to the bank. So forex services that also are given, although RBI is the sole responsible authority for this, but with the knowledge of the bank, some of the commercial banks are authorized to do the forex business, and those kind of businesses basically are done by commercial banks at the time of requirements. That is what they deal with, forex business. So they can provide the overdraft facility. Commercial banks provide overdraft facility in the sense whatever money you have as a deposit, on the basis of your profile or on the basis of your future cash flow generation capacity, OD facility can also be given, or OD can be issued to the customer if they need. It may not be applicable for all, right? But within certain conditions of the overdraft facility, it can provide to the customer if they need, even if they do not have much money as a deposit base in that particular amount. The discount, the bills of exchange, bills market basically, any kind of bills which are issued for any kind of purpose, those kind of discounting facilities are only available within commercial banks, as a bill can be shown to the commercial banks to get back that particular money whenever the bill was issued. And today's world, the one of the most important services what our commercial banks are giving is credit card. So you do not have to hold the money with you. No cash transactions. All kind of transactions can be done by credit card, and credit card basically makes your consumption pattern very smoother. So your consumption also can increase because of that. Indirectly or directly, it is affecting the total GDP or the output of the economy. So these are basically this credit card, which is one of the major services. So what they provide, you do not have to go through the bank, because they provide the ATM service. So even at midnight, if you need some cash, the money, right, you do not have to go to the bank. So whatever money you have kept against your account, you have the debit card which can be used. So also, like the credit card, they have provide, or they provide in today's scenario, we are doing this called something called as online banking. So those banking services are given by commercial banks. So now private sector, so now private, like what you call as private banking. So some specific kinds of services are also given to some high net worth individuals, as well as the people who are active participants in the commercial bank, or the major customers of the commercial bank. So they also provide mobile banking. Technologically, the banks are now very strong. The mobiles are also good enough for banking transactions. And another, for the small savings point of view, the banks also provide the public provident fund account. So you can open PPF account in the banks. The maximum amount in a year that you can deposit is 1,50,000 rupees, but that services or that accounts only can be always opened with commercial banks. So instead of going to any other specialized agency, those kind of services you can get from the commercial banks, and that is one of the small savings, right, which can help you in future for any kind of purpose or any kind of requirements. So keeping all these things in mind, it is extremely clear, but also, let us understand that the commercial banks has much a wider services that they offer, right, as bank. So now let us understand how the management of non-performing assets happen. First of all, let's understand what is a non-performing asset. A non-performing asset is a classification which is used by financial institutions for the loans and advances on the principal in past due and or on which no interest payments have been made for a period of time. In general, loans become NPA when they are outstanding for 90 days or more. Though some lenders use a shorter window in considering this loan or advance past due. A loan is classified as a non-performing asset when it is not being repaid by the borrower. It results in the asset no longer generating income for the lender or bank because the interest is not being paid by the borrower. In such a case, the loan is considered in arrears. If you look at subclassification of non-performing assets, lenders usually provide a grace period before classifying an asset as non-performing. Afterward, the lender or bank will categorize the NPA into following subcategories. First, standard assets. They are NPA that have been past due for anywhere from 90 days to 12 months with a normal risk level. Substandard asset. They are NPAs that have been past due for more than 12 months. They have significantly higher risk level combined with borrower that has less than credit. Banks usually assign a haircut, that is the reduction in the market value, to such NPA because they are less certain that the borrower will eventually repay the full amount. Then we have doubtful assets. Non-performing assets in the doubtful assets category have been put, have been past due for at least 18 months. Banks generally have serious doubts that the borrower will repay the full loan. So this case of NPA seriously affects the bank's own risk profile. Last is loss assets. These non-performing assets with an extended period of non-payment. With this class, banks are forced to accept that the loan will not be repaid and must record a loss on their balance sheet. The entire amount of loan must be written off completely. Now let us understand how these NPAs work. Loans are addressed above and not switched into NPA category until a considerable period of non-payment has passed. Lenders consider all the factors that make a borrower late on making interest and principal payments and extend a grace period. After a month or so, banks typically consider a loan overdue. It is not until the end of grace period, typically 90 days of non-payment, that the loan becomes a non-performing asset. Banks may attempt to collect the outstanding debt by foreclosing on whatever property or asset that has been issued to secure the loan. Now, for example, if an individual takes out second mortgage and that loan becomes an NPA, the bank will generally send a notice for foreclosure on the home because it is being used as a collateral for the loan. Now, what is the significance of NPA? It is important for both borrower as well as lender to be aware of performing versus non-performing assets. For a borrower, if a non-performing and interest payments are not made, it can negatively affect their credit and growth possibilities. It will then hamper their ability to obtain the future borrowing. For the bank or a lender, interest earned on loans act as the main source of income. Therefore, non-performing assets will negatively affect their ability to generate adequate income and thus overall profitability. It is important for the banks to keep a track on their NPAs because too many NPAs will adversely affect their liquidity and growth abilities. Non-performing assets can be manageable, but it depends on how many there are, right? Or how many they are, or how far they are past due. In a short term, most banks can take on a fair amount of NPA. However, if the volume of NPA continues to build over a period of time, it threatens the financial health and future success of the lender. That is all for this video. Thank you.